Let's break it down. For years, Silicon Valley ran on a simple fuel: cheap money, big dreams, and global capital willing to fund losses today for dominance tomorrow. And one of the biggest sources of that global capital wasn't a US pension fund. It was Saudi Arabia. Now here's the story that's been building quietly. Saudi Arabia's Public Investment Fund, the PIF, has been reducing parts of its US exposure, scaling back some investments, trimming US stock holdings, and signaling a broader shift toward domestic priorities and selective partnerships elsewhere. This isn't a Saudi Arabia hates America story, it's a capital has a strategy story. And if you understand how venture and tech financing actually works, you'll see why even a partial pullback from a mega investor can feel like winter in the ecosystem. So let's walk through what's happening, what's real, what's hype, and what it could mean for tech going into 2026. First, what is PIF and why did it matter to Silicon Valley? PIF became famous in tech because it helped power the growth at all costs era. The biggest symbol was SoftBank's Vision Fund, launched around 2017, where Saudi PIF was a cornerstone investor, reportedly around $45 billion committed to that first fund. That Vision Fund then poured money into the 2017-2021 boom: ride-hailing, delivery, enterprise SaaS, fintech, consumer apps, basically the entire unicorn factory. And it wasn't just SoftBank. PIF also made direct bets in public companies and private deals, and it participated in the broader VC ecosystem as a limited partner. The point is, Silicon Valley wasn't only funded by US money. It was funded by global pools chasing high returns in a low-rate world. Now, what changed? Two major forces hit at the same time. Number one, interest rates. When rates were near zero, investors were desperate for returns, so venture and growth tech looked attractive. But once rates reset higher, suddenly safe bonds don't look so boring. And risk appetite changes fast. Number two, strategy. Saudi officials have openly discussed reducing overseas exposure to fund domestic priorities: Vision 2030, infrastructure, mega projects, events, and industrial build-out. That doesn't mean no foreign investments. It means we're not spraying money everywhere like it's 2019. And this shift shows up in real numbers. Recent filings and reporting show PIF's US public equity holdings have declined significantly from the peak years, with a reported US equity portfolio around $19.4 billion in Q3 2025, down sharply from levels seen in 2021. Important detail, that's public equities reported in filings. It's not the full picture of every private deal, but it's still a big signal about direction. So, what does this look like on the ground? It looks less like a dramatic panic sell and more like a slow rebalancing, trimming positions in some US-listed companies, not renewing some commitments at the same size, and being more selective about where new money goes. And yes, one clear signal from earlier years: Saudi PF did not become the same kind of anchor for SoftBank's Vision Fund 2 the way it did for Vision Fund 1. Now here's the part that gets misunderstood. People hear PIF reduces US exposure, and they assume that automatically means America is collapsing, or Saudi is dumping the US for China. Reality is more subtle. Saudi money is not disappearing from the world. It's being redirected based on national priorities, and it's also being used to build leverage with multiple partners. Saudi Arabia has deepened financial cooperation with China too, like signing memorandums with major Chinese financial institutions worth up to $50 billion to enable two-way capital flows. That doesn't mean China replaces America. It means Saudi is playing a multipolar strategy: keep options open, build influence in more than one direction, and invest where the strategic return is biggest. Now, let's bring it back to Silicon Valley. Why does even a partial pullback matter so much? Because the tech startup model is built around one assumption: next round funding will exist. Most startups don't survive on profits. They survive on runway: seed, Series A, Series B, Series C, and so on. And for years, the system worked because capital was abundant and competition among investors pushed valuations up. But once funding tightens, here's what happens: fewer deals, smaller rounds. Tougher terms down rounds, delayed IPOs, layoffs, and a higher startup death rate. This is why people talk about venture winter. Now combine a rate reset with a sovereign wealth fund shifting priorities. That doesn't create the winter alone, but it can make the winter longer and colder. Because the question becomes, if a huge global investor steps back, who replaces that scale? You don't have many funds in the world that can casually inject tens of billions into high-risk tech. Some sovereign funds invest mostly in conservative public markets. Pension funds have been cautious after mixed VC returns. Endowments have their own cycles and constraints. And geopolitical restrictions make some foreign capital more complicated. So what's the real consequence? It's not Silicon Valley dies tomorrow. It's that the ecosystem becomes more selective and less forgiving. In the cheap money era, growth story could raise money again and again. In the tighter era, investors demand real revenue, real margins, real path to profitability, and real defensibility, which sounds healthy. Until you realize it changes what gets built. A lot of moonshots die in this environment. And that's the deeper issue. Innovation ecosystems thrive when you can fund 1,000 experiments because you expect most will fail. If capital tightens and experiments shrink, you don't just lose startups, you lose optionality. Now here's the part Silicon Valley doesn't love to say out loud. This is also a geopolitical story about where the next decade of tech is financed. If more capital flows into Asia or into domestic Gulf tech buildouts or into non-US funding ecosystems, you gradually build alternative innovation centers. Not overnight, but over 5 to 10 years, capital shapes talent, talent shapes companies, and companies shape dominance. So what happens next? Here are the scenarios. Scenario 1. Repricing, not collapse. Saudi and other global investors don't abandon US tech. They simply demand better terms, better discipline, and more strategic alignment. That means fewer hype deals and more real business deals. Scenario 2. The long winter. Rates stay higher for longer. IPO windows remain narrow, and big pools of capital remain cautious. That means more consolidations, more shutdowns, and more pain, especially for late-stage startups stuck between private markets and the public market. Scenario 3. A capital reset with new winners. Certain sectors still attract funding because they are tied to national priorities. AI, infrastructure, defense tech, cybersecurity, energy, plus grid tech. Advanced manufacturing, semiconductors, and anything tied to sovereign competitiveness. That's where money concentrates. While consumer apps and unprofitable growth-only models struggle. Bottom line, Saudi Arabia doesn't have to pull 90 bowers overnight to change the mood. In a system built on confidence and follow-on rounds, a big investor simply shifting posture, trimming US holdings, prioritizing domestic build-out, and diversifying partnerships can reshape the environment. Silicon Valley isn't just competing on talent anymore. It's competing on capital discipline and on geopolitics. If this breakdown helped, subscribe, like, and share. And tell me in the comments, do you think this is a healthy reset that kills hype? Or the start of a long capital drought that slows innovation in the US?